lower. Okay, so this is my swing trading model, and I'm applying it to targeting. So the way you do it is you take your Fibonacci and you anchor it to the highest body. It could be an open or a close, it doesn't make a difference, but you anchor it on that. Notice I'm not putting it on the high here, and I'm doing the same thing with the lowest open or close in this swing low. This retracement up, I'm measuring the distance in terms of range with the bodies of the candles. The first time I taught this on YouTube, I had a lot of folks scratching their head and many trolls saying, he doesn't even know how to use a fib. I'm showing you how the algorithm is going to read the price. Okay, the wicks and the tails are all distractions. That's all going to be largely attributed to what the, especially if you're trading with Forex, and obviously I am aware that this is not Forex, but I learned this through the models that I employ with Forex. Now, it's a carryover in terms of analysis because you can apply it here as well. It wasn't always like this. When there was open outcry only and there was no electronic trading, this wasn't as pure as you're going to see and as it's been shown in the past by me in other videos and examples. But by having a measurement from the highest body in this swing up, in this swing low, the lowest body, that means the lowest open or closed, okay? I'm anchoring the fib on that. The settings on the Fibonacci I've included here, and these are the ones that's highlighted for this illustration. So below this low, we're looking for it to run into sell side. So if it goes below this low and aggressively expands lower, this could be your next target, 45.14.5. If it goes below this one, we can anticipate it trading down to what? 45.01.25. Now, the question you're going to probably have in your mind is okay, this is all fine and great, but how do we know which one to pick, ICT? If you put 1,000 lines on your chart, ICT, eventually somebody's going to see one of those levels get hit, and then you're going to make a video and say, see how smart I am? I've seen all of your arguments. I've seen that kind of stuff tossed around in the forums and such. So if we look at the idea that 45.04.25 is just below what level? That daily bullish order block at 45.04. Well, at 45.04, and we're getting a measurement down here, that means we could see it trade down to that level here. Now, if you look up here at this level right there, that low is exactly the candle's low right there. Don't take my word for it. Go over to TradingView, pull up the June contract for 2022, E-mini S&P. That is your daily low. You can't predict daily highs and lows, ICT. That's impossible. Well, it is possible if you understand the elements that these algorithms operate under. And my question to you is, can you get any better than that? Is there any other measurement in terms of precision that gets you any closer to 45.01.25? Not when the low is 45.01.25. Look at the reaction there. Now, the order block level is just right here, but it stabs down into what the algorithm is going to measure. So there's the order block. It wants to go down to it anyway. There's relative equal lows. It knows there's liquidity down there. And you have the measurement. So the precision element is only going to be beneficial if you have all the other narrative incorporated with your analysis, that being the market's likely to go lower because we ran out those relative equal highs on the daily chart. We created this swing high. We broke lower aggressively. We're likely to trade into that daily bullish order block. Then we have this retracement here. It completely closes in all the imbalance that's between this low and this high of that candle. It rebalanced all that, and then we roll over. Here's that gap I mentioned. Trades up into that. We anticipate what? The candles after this candle closes. We want to see acceleration to the downside. We get it. The market starts working lower, lower, and finally, right on a dime, that candle is that low, and that's your swing projection that I teach in this YouTube channel. You will not get that measurement if you use this swing high and that swing low. That's why everybody that uses Fibonacci struggles. oh, Fibonacci is a joke. It's not a joke if you are doing the measurements correctly. Now, these are just targets, but they are more meaningful when you apply and layer other things in analysis, like the purpose of running to liquidity below those relative equal lows into a discount array, which is the bullish daily order block. When you bring that together, you get these types of results, which is perfection. There's nothing better than this, folks. You cannot improve upon perfect. All right, so taking this a little bit further, now we're into a 15-minute time frame. The opening price, again, is this candle here, which is midnight, New York time. The opening price, that candle, you extend that out in time. If you're bearish and you are looking at your daily chart, because the majority of your analysis should be framed on your daily chart, where is it likely to go? Where is the expansion likely to take price, higher or lower? That's the main thing you're trying to look for, because that's going to carve out your bias. So if you know that the likelihood of price wanting to draw down to this daily bullish order block, and we have that level of 45.01 and a quarter, which is that candle's low, we don't need to have that yet. But we know that this is going to be a draw on liquidity because it's also below those relative equal lows that I mentioned when we were looking at the higher time frame chart. So all of this here is a buildup into a premium. The market then breaks aggressively. What does it create here? What happened here? We had a displacement down. Did that take out that swing low? Yes. Does it trade up into that imbalance right here? Yes. Does it trade above the opening price? Yes. How many boxes did we just check off there? A whole lot. Probabilities are now going through the roof that this is bearish. Then the market breaks lower, trades down to the old swing low, sell side liquidity resting below there. Watch what happens. We trade down through it, and then we aggressively rebalance all of this down move. We come right back up into it, bearish order block, then sells off another wave into this short-term low, deeper below this low, and into, eventually, into the lunch hour and past it for the daily bullish order block. Now, when you look at this type of price action, you might not see that as an entry, but it is taught to you in this mentorship on YouTube. That is the lesson right here. Because if you look back here, we have these highs. We trade above it. Does it break below? It does. Does it get an imbalance? Yes. Does it trade up in here on the 9:30 opening? Yes. And then does it run where we want it to? Liquidity and discount array in the form of a bullish order block? Yes. But what other setups are here? Because I mentioned in my Real Money, Real Results series where I was showing actual live account results and proving that these things make money, not just in demo. And by the way, I appreciate all the feedback I'm getting in the commentary section of each video, the comment section. But I've read a lot of the questions about, what do I mean by having no more than 4 trades? 2 trades in the morning, 2 trades in the afternoon. What did I mean by that? Because I read one guy, he was saying, I can't even find, 4 examples of this. Or I may not be saying this correctly, but he can't find that many examples of it forming over the course of a week, let alone a few times in intraday. So we're going to walk through today's price action and show it with clarity. All right, so here's the opening price again on a 5-minute chart. Here's the 15-minute time frame fair value gap. And the market trades right back up into it above the opening price. That's what it would look like on a 5-minute chart. Notice it does not look clean like it does on the 15-minute time frame. Let's go back up one more time. See the gap here? And that run right there at 9:30? That, coupled with this time frame, you probably wouldn't see that as a sell. You would want to see this filled in. But you got to look at the higher time frame. The higher time frame, 15-minute time frame, is providing you the framework. It's giving you context that, okay, this is all we need. We don't need it to trade up into that. It could, but we don't need it to. So when it trades up there, then it starts to break down. It rebalances, breaks down again, works into that short-term low, sells off again, retracement, sells off again. In here, this is your entry at the opening. So in the morning session, you typically have 2 to 3 setups because you have volatility coming in at the opening being 9:30 New York local time. That can be very tricky. If you're not really sure what you're doing, you can get caught up in the initial volatility and offside real quick, and it can run against you aggressively and hurt you. I prefer to see my students look for the initial move to kind of like qualify what you expected. Lower prices, right? So does it give it here? Yes, it does. So how can you participate in something like that and still have the bias behind you and have multiple setups that you can take? Well, let's take a closer look on the lower time frame. Here's the 1-minute chart. Here's that return back up into the fair value gap on the 15-minute time frame, and wasn't so clear with the 5-minute. But now look what we have here. Small little imbalance there. That fair value gap right above a short-term high. We trade up into that there on a 1-minute chart. You would see that as a setup for the 1-minute chart. Before I go any further, I want you to pause the video. I know some of you don't like to do this because you just want to get through it. You're watching the video at 2 times the speed because I talk slow. This is a time when you want to stop. Slow down because you will cheat yourself out of learning. This is the little moments, like when I'm teaching my private group, these are these opportunities. If you waste them, you do not learn the best way. Okay, there's a good way of learning, and there's the best way of learning. And the best way is actually participating, not just casually watching. Don't Netflix binge watch ICT. This is where you stop the video, ask your spouse or whatever, to give you a couple minutes to focus, undisturbed. That way you can pull out the things I'm trying to show you in this lesson. Otherwise, it's just another, event where I'm talking about hindsight. But what I'm showing you here is something that repeats every single day. This is how I can go in every single day and take money out of the marketplace. I took the live account up another $1,000 today, so we're over $51,000. And these are the types of setups that you can do. You can find these, and you don't have to have the absolute perfect entry at the opening. You don't need that. Okay, that's the benefit of what I'm sharing here publicly. I want you all to have the ability to feed yourself and your own family, not to rely on a job. If you look for these types of setups with this logic, I am confident that you can do what I just said. And those that really want to supercharge it can take it way beyond that. Competitions, whatever. But we have the logic here. That's that old short-term low. All I did was extend the line out because it doesn't exist in the chart over here because I don't have enough of the data showing. But that short-term low, that was a fulcrum point, remember? That's this low here. So I'm referencing that, showing that there's where the sell side liquidity is. But I want you to pause the video and go through this price action and find the setups that you would see as a shorting opportunity if your bias was in line with what I'm suggesting here, as it should have been, being bearish. Okay, I'm going to continue the conversation. If you are not ready, you've missed your opportunity. All right, so the first fair value gap here, right there, because we have this short-term low broken with the run lower. So there's displacement there, obvious displacement, very energetic. And we have this candle's high, this candle's low, and the market returns back up into it. You can go short there and look for what's the first objective, that fulcrum point, that short-term low. Aim for the liquidity, so your target would be there. So you could do, like, say you did 2 contracts, entry here, short here too. You can take one off here, let it ride, and then see if you can get that lower time frame objective later in the day. Now, I don't want to take entries during the lunch hour between noon and 1 o'clock, but you can take profits if you're doing like a partial, like if you did one here. If you did 2 short contracts here, you took one off at your first target, and you want to see if you can get the other objective. If you have a limit order at the order block level, plus, a couple points,